Welcome to the Taxing Subjects Podcast. I'm Ryan Norton. Since it was introduced by the Tax Cuts and Jobs Act, the Section 199 Cap A Qualified Business Income Deduction has been a source of confusion for taxpayers and tax professionals alike. That's why the IRS has been hard at work developing rules and forms for taking the QBI deduction. Today, we've invited Drake Software Vice President of Strategic Development, John Sapp, CPA, to help explain QBI and discuss some of the latest developments on the topic. Welcome back to the show, John.
Hey, Ryan. How are you doing?
Doing very well. Got through the Christmas holidays in one piece, so that's always good news. How about you?
Just in time to talk about QBI.
I mean, that's the thing people were talking about at my Christmas table, for sure. Well, it is great to have you on. You've been on a bunch, and one thing I do know is you're a frequent presenter at the Drake Update Schools, and I would just guess you've probably had questions. You've fielded those about
Sure.
QBI.
There's still a lot of confusion, interestingly enough, about QBI. I mean, we've had it, for a good bit of time now to kind of digest and kind of think about it. And as soon as it came out, I think one of the most confusing things for a lot of tax professionals especially was we had a certain foundation of understanding of tax law all the way back from the 86 Tax Reform Act of how we thought about rental properties. Everyone understood S-corps and pass-throughs and Schedule Cs and whether the trade or business under Code Section 162, those definitions applied to those, which are mainly around profit motive and are they actually being treated as a business. There's always been some ambiguity around rental properties, and that's probably where most of the confusion comes from is just around how do we think about those rental properties, because we're so ingrained with thinking about them from the 86, passive activities. Is there material participation? Is there some type of at-risk rule? And all of that is determined at the taxpayer level. In other words, it's the activity that's performed by the taxpayer, not the actual entity itself.
That's probably a good place to start then, as far as just giving us a general understanding of QBI. So if you could just talk about like what business structures do qualify for QBI. You've mentioned rental properties. Also, what types of business income qualify. And then you mentioned that confusion. It is a new thing. Let's talk more about that too.
So it is any trade or business other than C Corp. C Corp's got a lower tax rate in the Tax Reform, Tax Cut and Jobs Act. Whereas, to kind of offset that, the corresponding for small businesses or for businesses that weren't in a C Corp structure, the QBI came along, which basically gives every trade or business a 20% of their net income as a deduction for taxable income. So it's the calculation's a little bit more complex than that, but that's basically it. So every trade or business that was subject to a lot of limitations, which I'm not going to put up a PowerPoint slide and show you those limitations. So you can thank your lucky stars, gets a 20% deduction. But the ambiguity comes around whether things are trades or businesses or not. The other things are quantitative. In other words, you can just do the mathematical calculation and get to it.
Gotcha. Could you talk about maybe aggregating businesses with respect to the QBI deduction?
Well, let's back up a second. Because aggregation, this year in particular, it changed a little bit. Last year, aggregation had to be done at the taxpayer level. In other words, the taxpayer had to decide, do these businesses meet it's 3 out of 5 tests there that a business can meet in order to aggregate. But really, with the new Safe Harbor rules, it makes aggregation a little bit less of a consideration, but we do have one other new thing with aggregation this year is the actual entity itself. In other words, if you have an S-corp or partnership, for example, with lots of entities, lots of trades or businesses, or what the rules might call enterprises, rolling up into that particular entity, the aggregation election can actually be made at the entity level, which was a change this year. And there's lots of rules around aggregation. Does an entity have shared services? Do they have something alike? You have to kind of find some things alike, and there's some rules you have to go through in order to find out, does it actually qualify? For example, a business that runs a restaurant and a catering business, if they're two different trades or businesses keeping two different sets of books and being reported separately, you could actually aggregate those probably if they shared employees and they had some other things going on. But aggregation was one of the confusing items, but really the trader business issue was probably a bigger issue.
Now, last season, preparers had to use worksheets from Pub 535 when they were figuring QBI for clients. This year, there's two new forms. The Form 8995, Qualified Business Income Deduction, Simplified Computation, and then the 8995A, Qualified Business Income Deduction form. Could you explain these two forms?
Well, the 8995 is for simple calculations. So basically, any taxpayer whose taxable income before QBI for a joint return, for example, is below $321,400. I think I have that written down. Yeah, $321,400. Last year it was $315,000. If their income's below that, then they can use the simplified method, which basically means there is no limitation other than the limitation on taxable income. It can't exceed 20% of taxable income. There are other limitations that apply once they go over that $321,000, but if they're below that, then they can use the simple calculation, which basically takes the qualified business income and multiplies it by 20%, and that's the 8995. The 8995A is the complex calculation, which means that you have to phase in up to $421,000. You have to phase in a limitation based on either W-2 wages for that entity, the applicable W-2 wages for the entity. Another confusing point that a lot of folks found, especially at S-Corps, where you had an equity holder that was doing the QBI calculation. The question came up with, are the W-2 wages in that complex calculation the W-2 wages of the entity or the W-2 wages received by that person? So if I'm an employee of an S-Corp and I receive $20,000 in wages, but I own the entire S-Corp and there's $100,000 in total wages, a lot of folks were confused by the fact that they would use the $100,000 and not the $20,000 number. But the 8995A is the calculation that takes the W-2 wages and the unadjusted basis of assets, those limitations, in as part of the calculation, and the phase in and the phase out. So all of that occurs on that 8995A.
Now, just to kind of jump back to something you mentioned the Safe Harbor rule, and they published that in September in Notice 2019-07. So this September was when that was published.
The final. Yeah, right. We got the preliminaries earlier in the year that allowed people to make the election in 2018, actually. So, for 2018 returns this tax season.
Right. So could you explain the types of businesses that are affected by the Safe Harbor rule, and then when can they use it? So
the Safe Harbor goes back to the original point that I was making, which is always prevalent in my mind, it seems, whenever we talk about QBI, and that's rental properties. How do we define whether something's a trade or business, especially in the context of the way we've been programmed to think about material participation and passive activities and those types of things. So what Safe Harbor does is takes all of that and basically says, we're going to give you something you understand. So we're going to give you a 250-hour participation rule. So if there are 250 hours of activity in a particular trade or business, then the IRS has said, we're going to deem it a trade or business. You don't have to worry about all of the other criteria that the courts have applied over the years, the facts and circumstances, is it regular activity that applies on a continuous basis, is there regular income being generated, those types of things. All of those things that are, different court cases may look at them from different perspectives, can be thrown out and say, if you hit this 250-hour rule, you keep separate books and records, and beginning of 2020, if you keep contemporaneous records of the hours, then if you hit that 250-hour rule for this business or the group of businesses that you put together, we will deem it a trade or business, and you can take the corresponding QBI. That's the Safe Harbor in a nutshell.
Now, with the Safe Harbor, can you aggregate businesses under that rule?
Well, it's a little confusing because there's no need to, because once you take the Safe Harbor rule, then you've grouped all of the all of the trades or businesses that are in a particular bucket. So there's only two buckets. The first bucket is residential properties, residential rental, right, and the second bucket would be commercial rentals. You can do each one individually, but the advantage of grouping them together is you have more businesses to accumulate that 250 hours. So if you had one business that only has 10 and you have another one that has 270, you group those together for the safe harbor. Both of them would be deemed trades or businesses. So the advantage is if you have multiple businesses, the ones that potentially are in the gray area of being a trade or business can get swept up in that safe harbor and be treated as a trade or business and qualify for QBI. So they're not only treated as qualified for QBI, they're treated as one trade or business. So there's no reason to aggregate because it's already one trade or business. Aggregation still treats them as separate trades or businesses, whereas the safe harbor treats all of those in that particular segment to be one trade or business.
Well, we've covered the new forms. We've hit the safe harbor rule. Is there anything else that you want to talk about with respect to QBI? Maybe clarify for people?
Based on the conversations that I have with folks, I think there's some fear of claiming QBI. In other words, number one, there's some sense of, at least on the taxpayer level, this is almost too good to be true, so I don't want to push my luck too much. And on the second piece of that, there's a lot of differing opinions on, especially on the rental property side, on what constitutes a trade or business. And there's a lot of conflicting court cases out there that someone could cite and make a particular argument. And I think it's a good idea to raise red flags for folks and have them be aware of some of the issues that they may face. But the bottom line is most rental properties that have some activity in them that are run by an individual will qualify as a trade or business. I had some folks last year that just told me, they'd asked me several questions via email, and then at the end of it they said, well, I'm just not going to take the deduction. It's just not worth the risk. And I think that's the wrong approach. I think we have to take it from the approach that this is a law that was passed by Congress with the specific intent of helping small businesses. So it's our job really as tax preparers to help them navigate those waters and understand that the purpose of the law is to help that small business and give them this deduction.
Right.
So instead of looking for a way it doesn't qualify, I think our job should be, and not to be overly aggressive with it, but to rightfully find the deduction for those small businesses that should take it.
John, thank you so much for joining us again to talk about QBI. It's always been a pleasure to talk to you.
Thanks, Ryan. Always great to be here.
That'll be it for today. We'll see you all on the next Taxing Subjects podcast.